for the opportunity to address the group this morning. The 35th anniversary is a major achievement. Most organizations don't hang around for 35 years. Isn't that true? It doesn't take that long to cycle through the Fortune 500 these days, and evidently right now it's getting a lot shorter. So, my talk this morning is about the engagement factor, and so we can make sense out of that in the next 40 minutes or so. The first thing that I would ask you is how many people here have ever found a really, really super creative use for a stapler? You probably were waiting for that question this morning. And the way in, it's like, you know, I bet he's going to ask about staplers. Yeah, going to be all set. Actually, the reason I bring that up is that in about 6 years ago, I was teaching at Hewlett-Packard over in Roseville. I don't know if anybody here is here from the HP Roseville site, but I was teaching a course called Hewlett-Packard Program Management. And I was in front of the group, and I'd actually asked them to just start a new activity, and I looked down, and the fact of the matter is that my pants had split from like the worst possible spot all the way to my cuff on my right leg. And so you can imagine that at that point I was having to run through a significant number of strategic options. Like, what am I going to do about this? Well, to make a long story short, essentially what I ended up doing was rummaging through cubicle after cubicle trying to find a stapler to staple my pants back together to get over what you might call my very worst wardrobe malfunction. And so what does that actually have to do with the engagement factor? Well, here's basically what I would say. I don't know how many people saw the current economic climate coming. Those would be the people in the room here who have converted absolutely everything to either gold or cash and have not been damaged in any way, shape, or form relative to the economic decline. Well, actually, maybe it's affected all of us, and the fact is maybe we didn't see it coming. I didn't see that wardrobe malfunction coming either. But the first challenge that I would give you today is actually start to connect some dots around what creative use of assets are we going to have to engage in order to deal with the realities of the economic situation that we face today. So, first challenge of the day is creative use of assets, because here's how creative we need to get. On the right, you will see the pie chart that adds up everything we spent in Europe, the Louisiana Purchase, the moonshot, the savings and loan prices, the Korean War, the New Deal after the Depression, the Iraq War, Vietnam, and every single dollar we've ever spent on NASA. Okay? You add them all up, and you put them on a constant dollar basis. What we did in November of 2008 was bigger than that. That does not include the stimulus package. So what I would tell you is that in terms of where we stand today, we stand in unprecedented space. So every single planning assumption we've ever used relative to the continuity of our business models, the economic situation, and where it's going in the future, every single assumption on which we based our plans is now invalid. And so essentially, we need a stapler and creative use of assets in a very, very, very large way. And so, on the left, you'll see a chart that sort of charts the stock market. Everybody's seen this chart. Can you actually turn on the television these days without seeing some version of that chart? And essentially, one of the things that's happening relative to Wall Street is it's not walk or don't walk, it's panic or don't panic. And so one of the things that I've noticed, and maybe you have too, is that here's a screenshot of an email account that I have that does nothing but news releases. Basically, this is my Gmail account that begins to just simply log those things that come on the Wall Street Journal, Business Week, and the other services that I subscribe to. And if you look down through there, how much gloom and doom is there? Now, there's a couple of pieces in there. Amazon's doing pretty well, and you probably find it very, very helpful that somehow chocolate popcorn says, "I love you like nothing else." Other than that, it's all pretty much downside communication. Is that true? So the question, one of the questions I would have for you this morning is, how badly is this messing with your head? Last night on CNN, there was a program about the American psyche. It's actually probably much more like the global psyche, correct? So how's the American psyche, how's the global psyche doing under the onslaught of this much negative messaging? What I would say is that is probably as big of an issue as we face, is essentially how we frame this situation mentally, and essentially how we engage it through our actions, both privately and from an enterprise point of view. So maybe you work for organizations that have taken the low-hanging fruit approach. Anybody actually been out picking low-hanging fruit lately? Knocking off the obvious, so to speak. Well, the first one is, just quiz time here. Make sure that we're all on the same game page. What do you call these? What are these? What are they? Calories, carbs. These are non-strategic pastries. So, the first thing you got to do is deny the donuts, okay? So that'd be one piece of low-hanging fruit. Second piece of low-hanging fruit, anybody know what this is? It's a meeting, yeah? Who's leading this meeting? As a consultant. Very good. So you've got to cancel the consultant. Get them out of here. Third thing, how about all this stuff? Planes, trains, automobiles, hotel rooms, restaurants. Now, got to terminate travel. So, right after you figure out any of this, like rocket science, denying the donuts, that's probably the first thing, first imperative. And then you cancel the consultants, and then you terminate travel. Beyond that, you probably got to get a little bit more creative, correct? Because is there any way to pull our business models back on track by doing those three things? Now, it'll help, sends a message, sets a tone. It might be somewhat effective. But probably won't pull our business model back on track. Probably going to need to do something a little more substantive than that. Our challenge basically is, you recognize this Where's Waldo chart, right? You are here. You are here. Anybody know where it goes from here? Anybody got an absolute lock on exactly where it's going? Down? Up, eventually? It's like the age-old joke about asking the stockbroker, so which way is the market going, up or down? The answer was yes, eventually. So, yeah, who knows? I mean, we might have some more contraction to go. Who knows how much? And then the question is, what happens? Do we actually make a fast recovery? Is it something that bounces back quickly? Do we make a slow recovery? Do we flatline for some indefinite period? Is that where we're going? Are we going to continue to decline? Or is this the apocalypse? It's over. Finish the coffee for this morning. It's basically your last meal. Just trying to cheer you up there a little bit. The dilemma is this. If you look at the limited amount of research that's available, if you look at, so what happens with companies in the downturn? Essentially, if you are a leader here, if you're a leader in cutting, so you're able to cut successfully and keep your business model as profitable as possible, the limited amount of research that I've been able to locate basically says you're going to underperform on the other side. Now, it's not extensive. It hasn't been, you wouldn't be able to find a database of thousands and thousands and thousands, but 250 is about the size of the sample. And so leaders in cutting tend to underperform on recovery by a factor of about 25 to 75. So essentially, if you're really, really super good at making cuts that make your balance sheet, your income statement look good under the down conditions, chances are, just roughly, that you're 3 times more likely not to be much of a performer on the other side of recovery. So that's the dilemma. First of all, how do you get it done in the short term? But on the other hand, how do you actually position the organization for expansion on the other side of wherever the bottom is?